traders here. This is Chris Capri with 2ndSkiesForex.com. I have a new trading video for you today, and the focus of this video is to talk about price action, order flow behind the price action, and transitions and trends. I myself try to trade price action trends as much as possible. I prefer trading trends more than counter trends, but when the opportunity presents itself, I do like to take counter trend plays or reversal plays. That just takes an ability to be able to read transitions, which we're going to talk a little bit about today. We're going to also be talking about how you can spot these transitions coming ahead of time in trends. Many of you have probably gotten into trends a little bit too late, only to find it reverse. When you found the trend, it was already well established and you thought, hey, this is going to continue. You get into it and it reverses and you wonder why. It's probably because you weren't reading the price action, the order flow, and the transitions that were presenting themselves in the charts in front of you. And they're there. You can learn to read these things with just a few models and techniques so you don't get caught on the wrong side of a trend. You don't get caught, trading with trend when it's about to reverse. And this way you can spot these opportunities ahead of time. Or on the counter side is when you're trading reversals, you're not trading into a very imbalanced trend that has shown no signs of transitions or changes in the order flow behind the trend. So that's what this video is really going to talk about. Now, I'm doing this on a 5-minute chart, but this can be applied on any chart, any time frame. The models and the techniques are still the same. So I'm just going to briefly break down this chart here for a moment. So today's price action on the 5-minute chart and the pound dollar was kind of interesting. It presented some interesting opportunities for both with trend and counter trend players. We had a impulsive move coming 30 minutes into the London Open, so European session, late European Open, and we have some selling. But UK holiday today with the bank being closed, very low liquidity going into the UK session, so the pound was just sitting there in a 10-pip range, consolidating. Now, some people might have thought that this might have been a buying opportunity, that it could have been presenting itself as some sort of accumulation. Accumulation from an order flow perspective is when the sellers are in control of the price action, there's a dominant trend in place, and what happens is the accumulation is usually coming from some heavy buyers, some large institutions. And what does the accumulation mean? It means that while the sellers are coming in for 50 million, 100 million, 200 million, that the buyers are holding the line in terms of meeting the sellers that are coming in. So if the sellers are coming in for 50, 100, or 200 million at that particular price, that the buyers are holding firm. That means they're buying those 50 million, that 100 million, that 200 million in selling contracts. And this can happen from an order flow perspective. This can happen with an iceberg order, usually a very large player. Maybe they have a 200 million order in there, but they've done it through an iceberg, so they're only showing, say, 20 or 50 million. And so when that first 50 million of selling hits that level, it gets bought up by the buyers there. So there's an accumulation of the buying there, basically. And then more sellers come in for another 50, for 100 million total or 200 million total. And that iceberg order now starts to open up, and it's just taking that. It's absorbing all the sellers in this case, or it's accumulating all those sell orders and buying all the liquidity at that price. So when the buyers are holding firm at a particular level or around a particular price, that's usually known as accumulation. But the thing about it is, it also, even though we can't necessarily see this, even if you have level 2 quotes, you can't necessarily see it because of the decentralized market in FX, you can see it in the price action. Very rarely does accumulation have a series of lower highs, lower highs, lower highs, while the low is pretty much stable throughout the entire time. We see that here, lower highs, lower highs, lower highs, much lower highs. And, then we see a 4-bar, 5-bar, bear bar with trend series of bars in a row. Almost never will accumulation have that type of price action structure. This is a continuation pattern. This is not accumulation. So we can know that, when we see these types of things with these similar structures in place, that it's very unlikely that it's accumulation buying at that point. And if anything, we should just be thinking, hey, this is a with trend play here. Now, we break through this floor here, and obviously there were some intraday buyers who were buying at this level. Maybe they were making their 5-10 pips scalping off this level here. But anybody who was late to the party as of this move was getting stopped out. And more than likely you had a bunch of sellers start to come in here to say, okay, enough's enough. You know, the defenses are weak. We're going to take over. That's why all of a sudden there's no 3 or 4 bar bear bars in a row, but then all of a sudden we see that 4, 5, 6 bars in a row. So you have sellers here. You likely have some breakout traders that are selling here. And then you also have sellers here. Now the sellers here could have been the people who missed the initial breakout. They could have been the people that were here that are already in profit or seeing this as a logical pullback area. You know, it's a breakout pullback area, or what we call a roll reversal level. And also it's a 20 MA, so it's kind of a nice confluence there. So there could be the sellers that are here, they're also jumping here. The people that relate to the party that missed the breakout, they're getting in here. Or the breakout traders also realize, hey, this should hold, so I'm going to sell here again and to help further my trade here, basically. So these are the people that are selling here. It also could have been the people that were buying here that got smart. When they were stopped out, they said, hey, this is a breakout, and I'm going to take the pullback into this level. So those are the types of players from an order flow perspective that tend to jump in on these levels. But the bottom line is we had a very shallow pullback here into the 20 MA, into the roll reversal level, and the selling continues. Now, we're obviously continuing with trends. So I want to talk about how you can start to read these transitions in the trends. If we look at the move from A to B, this is a total of 7 bars and 15 pips. And it doesn't matter if it's 7 bars and 100 pips or 7 bars and 15 pips on a different time frame. It doesn't really matter. The bottom line is that we start to look at these types of moves and see if there are transitions in play. With 7 bars and 15 pips, you know, it's a pretty consistent move of all sellers after 7 bars and a gentle pullback into a corrective pullback into a roll reversal level and then continued selling. Now this second leg down, I want you to look at a couple things. I want you to look at this section right here, and I want you to look at this section right here after we examine this. From C to D, this is 23 pips, so it's a larger leg down, and it's only 2 bars more. So it's a significantly bigger move, almost, we're talking almost 45, 47% bigger, and yet it's only 2 bars more. So there obviously was some pretty good sellers in play here and no real buyers to push back on this here. More control or greater imbalance in the trend on the bear side of the market. But take a look at this pullback from D to E and compare it to B to C. What is it that you see here? You should see that the pullback from D to E is slightly a bit stronger and a bit longer than B to C. B to C is 5 bars, D to E is 7 bars. And it's a little bit bigger on D to E than it is on C to B to C. Excuse me, I gotta delete this line here, and fantastic. Okay, great. So what this should be telling us from the transition in this particular move here is that D to E shows an increase in the counter trend players. That's a subtle transition from B to C. Almost no counter trend players, more counter trend players. So this should be cueing us in that if we are trading with trend and selling this, that we should be wary of a greater pushback from the counter trend players or any other transitions that show themselves in the price action, because that would be 2 increases on the counter trend player side from here to here and from here to here. So these are clues that we have to be watching out for if we are a with trend player. If we like to trade counter trend and look for reversals, then we want to see more of these transition signs or these greater presence of the counter trend players. For those of you that want a companion article to this, make sure you check out my article on the site, How to Trade Price Action Trends, what you've been missing as I cover this topic in detail, what it means from an order flow and price action perspective, and how you can spot this. But these are transitions that you should be looking for. Now, let's take a look at this last leg down. The 20 MA still holds on this one here, but let's look at E to F. You should notice that E to F is significantly different than the C to D or A to B. How so? Well, E to F is only 4 bars, so it's less than half. It's about 45% of the largest move down, which was 9 bars, and it's about 57 or 60% less, there are 60% of the 7 bar move. So it's the shortest of all of them, yet it's at the third leg of this move. On top of it, it's the same amount of pips. This should be telling us that this is a huge transition in place. In fact, if you look at it, most of the moves from 2 bars, with the last bar being the largest bar in the entire chart of the day. So it's now 7.5 hours into the session, we've had about 150, roughly 5-minute bars, and we have one bar that's larger than any single bar combined. So what is this? This is a spike. This is what we call a spike, and it often results in a sharper reversal. Now, if you are a with trend trader, this is not the time to be taking a shallow with trend pullback like 1 to the 20 MA here. When you see these spikes, the reversal or the counter trend play is usually much larger. Why is that? What happens is from an order flow perspective, there usually is what is called a liquidity gap. So the sellers came back in at E here and they sold back down, but the move was so rapid, usually when the market pushes back, they're going to have a hard time finding sellers here because the move was so fast that either the sellers already exhausted themselves in this move here, the late retail players who've been chasing the trend got in here and they got in really late, but when we push back on that, we haven't had time to kind of refill the liquidity back at this level here or any on any of these potential roll reversal levels here. So that creates what is called a liquidity vacuum or a liquidity gap. And when that happens, those usually happen after sharp spikes. And when you see these sharp spikes, again, this is not the time to be taking a shallow pullback. This is the time to either be thinking it's time for me to exit my move, or if I'm a counter trend player, this is the times that I start looking to get in because the pushback is likely to be the strongest there is since then. And so we need to be constantly aware of this. Sellers need to be aware of this and start looking at profit taking, and buyers need to be looking at this as, hey, now is probably my opportunity or one of my better opportunities to get in. And so this liquidity vacuum just basically means that there isn't enough time for sellers to refill in this hole, basically. It's just too fast. It's kind of like if your infantry in the front of your army advances too far ahead and advances at such a fast pace that they separate from the rest of the group. When the other army, opposing army, defeats or gets past your infantry, there's going to be a much bigger gap between the infantry that you had in front of you and your next line of defense. And so it takes much more time to fill that gap. So that's what people are talking about when we talk about liquidity vacuum in this case here. But spikes are generally or usually equal transitions into trends. So these are the times from a price action order flow perspective that you need to be watching out for transitions. And if you look at the follow-up, go figure, we had our largest pushback of the entire time, and it's the first time we cleared above the 20 MA. And clearing above this 20 MA, I guarantee any of the really smart institutional investors that see this spike here, the institutional and bank trades, they see this, they're probably getting out when they see that spike or this strong pushback here. And as soon as that 20 MA is cleared, they're definitely out of the market. They're no longer looking to sell at that point. And if they are, they're looking for a much deeper pullback before they start looking to get long again. And if you notice, the market never regains the trend again. And now all of a sudden it's consolidating at this point. But this spike represented a transition in the trend. However, it wasn't the only clue. There were much greater clues along the way that you could have been reading in the greater presence of the counter trend players. Small amount here, a large amount here, big spike, okay, likely liquidity gap. So that's when we should start seeing these transitions. You can read these transitions ahead of time. They're present and they're available in the market. You just got to learn how to read them, learn the right models and tools to spot these. But there are definitely ways to read them so you don't get caught selling into a bear trend at the end of it, and you don't get caught trying to reverse or counter trend a move too early. So I hope you found this useful. I hope these ideas and concepts from a price action and an order flow perspective or in spotting transitions make sense to you. And so this is just a small token of the things we talk about in our price action course. So for those of you who are interested in learning much more advanced techniques than this, or more thorough concepts and related to price action and order flow, feel free to check out my price action course, which you can find on my website, 2ndSkiesForex.com. Until then, I look forward to your comments on this. I bid you all adieu. I'll see you next time.